Hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and today we're going to be continuing our conversation on budgeting. In the previous chapter, we talked a lot about budgeting, the master budget, the budgeting process, and planning. This is really a continuation of that. We're going to be talking about flexible budgets, standard cost, and probably the most important takeaway for this chapter is going to be this thing called cost variance, which simply means the difference. And we'll be spending a little bit more time in that area, and we'll definitely breeze through some of this because a lot of it is going to be a review. So let's go ahead and jump into our conversation on flexible budgets, standard costs, and cost variance. So like I said, we'll be spending quite a bit of time in the procedural part. We'll talk about things like total cost variance, materials and labor variances, overhead variances, and what they all mean. That's because I really feel that that's probably the most important part about this whole chapter. So we talked about the master budget. We talked about what it means. The master budget, we have our sales budget, which tells us how many units we need to produce. That's our production budget. And production budget gives me my cost of goods sold budget. Cost of goods sold budget goes into my cash budget, and it all comes around. That's the master budgeting process that we just talked about. Now, we're going to dive a little bit deeper, but we'll also talk about this thing called variances. But first, one thing you heard me say in the last discussion was I used this word called dynamic, a dynamic budget. And the reason why I like dynamic budgets is because I can make adjustments over time. So there's really two types of budgets, two types of budget approaches to budgeting. One's called fixed or static, and the other one's called flexible or dynamic. Now here's how it works. Fixed budgets are static. They don't change regardless of how much is being sold. Okay? It stays the same. I can predict how many units I'm going to sell each month. That's going to be the same. I can predict my expenses for each month. That's going to be the same. It's fixed. It doesn't change. The thing that I don't like about fixed budgets or static budgets is that if I expect an increase or a decrease in sales, I can't just go into the budget and change the dial. Okay, I can't make those adjustments. That's why I don't like static budgets. That approach is very rigid. Most companies that use a static budget are companies that are very standard. They have a set number of contracts, they have a set number of customers, and it's the same year over year. Okay, that's a fixed budget. The U.S. government uses the fixed budget approach. They say, here's your budget for each department in the government. Everything's fixed, doesn't change. Okay, those are fixed budgets, static budgets. I prefer this thing called a dynamic budget, also known as a flexible budget or a variable budget. Dynamic. And the reason why I like it is because I can make adjustments based off of the different amounts of sales, based off of the sales volume. Sales volume goes up or goes down. I can adjust the budget based off of those percentages for each month. And here's what it does. It creates this thing called a variance. So a fixed budget is a budget that does not change. It's set. Okay, it's set. And here's why I don't like it again. I got a fixed budget. if my actual sales comes in above my fixed estimate, then I'm over budget in terms of sales dollars. Now, you're saying, Dr. B, well, how could that be bad? You made more sales than you actually budgeted for. Yes, a grant is a classic example of a fixed budget. Thank you for that one. Yes. Because with a grant, you got a certain amount coming in from the grant money and a certain amount going out from the grant money for each line item. So yeah, that would also follow a fixed budget. Here's why that sucks. If you sell more or you got more that comes in than you planned for, that also means you're going to have increased expenses, increased cost of goods sold. So if I sell more, I also have more cost of goods sold. I also have more expenses. I also have more supplies, more insurance, etc. You can see the variance. So if you look at this variance, okay, you got your budget compared to your actual. The difference is called the variance. That's what the word variance means. It means the difference between. So I'm looking at the difference between the budget and the actual performance. You see two things here. There's a letter, F. I'm not going to say that altogether, but F means favorable, in favor of favorable, and U means unfavorable, or that's not so good. Favorable and not so good. Unfavorable. Favorable is good. Unfavorable, not so good. Now, sales being more than the budget, yeah, that's good. Absolutely, it's good to sell more. But you know what's not good? All the stuff that comes with it. The higher cost of goods sold, the higher selling expenses, the higher general administrative expenses, the higher total expenses. But if the total income from operations is greater than the budget, then that's favorable overall. So overall in this situation, it's favorable because my income from operations is higher than my budgeted income from operations. That's good. I like that. That's a fixed budget. And earlier I said I don't really like fixed budgets because I cannot make adjustments as time marches on. I can with a flexible budget. So if my budget is flexible, I can pump in additional budget for raw materials, for labor hours, for whatever, to improve the actual performance as it relates to the budget performance. Making those small modifications based off of the actual level of activity allows for the budget to be flexible. If I'm selling more than what I had budgeted for, I can increase the next month's budget for sales. That'll in turn also increase the other expenses and it'll put me more in line with the budget. That's why I like flexible budgets. You can turn the dials, right? You can tune the budget based off of the actual performance. So let me show you what it looks like. The flexible budget can budget for different levels of activity. If I'm selling more or if I'm making more units, then I can increase my total variable costs on the budget. The fixed costs, of course, are still going to remain the same. Fixed costs remain the same regardless of the level of output. You know that. But flexible variable costs, we know the variable costs will change with the level of activity. So the more units I'm selling, more units I'm making, the higher the variable costs are going to be. And so I can adjust those variable costs in the budget to be more in line with the budget. So the thing I like about variable budgets or flexible budgets is I can have a range the range, low, medium, high, tells me where I might end up. So here we go. So let's say at the low end, I might sell 10,000 units. In the middle range, I might sell 12,000 units. At the high end, I might sell 14,000 units. That's a nice range, okay? Based off of that range, I can estimate my variable costs based off of the range, yeah? And which means I can estimate based off of the sales amounts, I can estimate my contribution margin, low, medium, high. What stays the same? The fixed costs. What will be different is the income from operations. Sales minus total variable costs equals contribution margin minus fixed costs equals income from operations. My income from operations, based on the three different ranges, are different, of course. The reason why I like this concept of having a range, low, medium, high, in terms of sales, means that my actual performance, when I go to look at my actual performance in comparison to my range, it will be more in line with the budget. So in this example, I plan to sell either 10,000, 12,000, or 14,000 units. At the end of the month, I came in at selling 12,000 units. So I'm right in the middle of the range. That's nice, okay? My budget, I budgeted for $120,000 in sales. I came in at 125. Nice, great. My total direct materials, direct labor were a little bit high, so that's unfavorable because it's over the budgeted amount. Factory supplies, it's favorable because it came in under the budgeted amount. Utilities was over the budgeted amount, so unfavorable. Shipping expenses, office supplies, I had my budget. My actual came in under my budget, so it's favorable. Remember, variance simply means the difference. So you take your budgeted amount minus your actual results. Budget minus actual results. If it's a negative amount, it would be favorable. If it's over, it's unfavorable. In other words, if your expenses, if the actual expenses are higher than the budgeted amount, that's unfavorable. Okay. If your expenses are under the budgeted amount, then that's favorable. If your sales are over the budgeted amount, that's favorable because that's additional revenue coming in. So that's the important thing to know about variance. It means the difference. So if we look at this budgeted performance for the month of January, I got 5,000 favorable variance for sales, minus my total variable cost variance of 1,800 equals my total contribution margin variance of 3,200, favorable because it's over the budgeted, minus my total fixed cost variance of 200 equals my income from operations variance of 3,000. It's favorable, again, because the income from operations being over the budgeted amount is favorable because it's additional income for the business, yeah? Now, we know when we budget in a flexible system, we can make adjustments based off of the expected sales, low, medium, high. There are standard costs that can be used in the budgeting process. The standard costs exist based off of the conditions, the operating conditions of the business. They exist based off of people, processes, time measurements, accounting studies, etc. The standard costs are based on the expected level of performance. They're based on the standard cost for direct materials, direct labor, and factory overhead. The standard costs are used in the budgeting process because I can make adjustments. Standard costs help me to set prices. The prices based off of direct materials and the quantity standards. Direct labor is set based off of the labor rate times the amount of time. And the variable factory overhead is set by the rate of factory overhead times the activities standard. In other words, I can set the cost of direct materials, direct labor, factory overhead based off of the standards. The standards are based on the amount of time it takes, times the price, or the quantity it takes times the price, or the activity standards times the rate. In other words, I could set a standard rate for direct materials, direct labor, factory overhead. And those standard rates are what I call standard costs. They're like benchmarks, right? So let's take a look at an example. Let's say we are manufacturing baseball bats. Okay. I have direct material, direct labor, factory overhead for each baseball bat. And I can create standard costs based off of the manufacturing of each baseball bat. How's that? For direct materials, I take the quantity times the amount per unit. Gets me a standard cost for materials. For labor, it's the labor hours times the dollar per hour. Gets me a standard labor cost. And overhead, labor hours times dollar per hour for overhead. Gets me a standard cost for overhead. So my total standard cost for each baseball bat in this example is $85. $25 from materials, $40 from labor, $20 from factory overhead. We call them standard cost because that's like our benchmark. It's our expected cost in each area. And then I would take that amount or those amounts to prepare my manufacturing budget, which will help me to compute my variances. Remember, variance is the difference between the actual and the standard or the budget. The difference between the actual and the budget is called a variance. If the actual cost is greater than the standard or the budget cost, then it's unfavorable. If the actual cost is less than the standard cost or the budgeted cost, it is favorable. These variances are prepared in reports, analyzed. The board of directors or the managers ask questions, there's some answers, and then, of course, we take actions based off the variances. If variances are too great, we need to make adjustments. Maybe we need to reduce costs somewhere, or something needs to happen, right? Because variances are not always a good thing. We want to be close to, in line with what we are doing. We want to try to get our budget closer to our actual performance. So how do you do that? Well, we make decisions based off of the variances. That's why it's important to calculate the variances. So to calculate the cost variance, we take our actual cost minus our standard cost, where we came in at minus our budget, where we came in at minus our budget. Actual cost minus standard cost. Now, how do we find actual cost? We take the actual quantity times the actual price. Actual quantity times actual price. That gets me my actual cost. How do I find standard cost? I take my standard quantity times my standard price to get standard cost. My total actual cost minus my total actual standard cost, my total standard cost equals cost variance. So actual quantity, that's the amount of actual materials or labor that I used, times my actual price, which is the amount that I actually paid for the materials or for the labor. So those are my actual costs. Minus my standard cost. Standard quantity, the amount it normally takes, the quantity it normally takes, the amount of time it normally takes, times the standard price, the amount that I would normally pay to get my cost variance. In materials and in labor, we find the price variance and the quantity variance to get the total cost variance. I know, it sounds crazy, right? First, I find my actual cost, actual quantity times actual price. Then I find my cost variance. Cost variance comes from the actual quantity times the standard price. Well, actually, first I find my actual cost. Actual quantity times actual price. Then I find my standard cost. Standard quantity times standard price. Then I find my price variance. It's my actual quantity times the actual price minus the actual quantity times the standard price. Next is my price variance. Price variance is simply the difference in price that I actually paid versus what it should have been. And I find my quantity variance. This is the difference in quantity. Actual quantity times standard price minus the standard quantity times the standard price. That gives me my difference in quantity. Standard price variance and the quantity variance give me a total cost variance. So, the cost variance is the standard quantity where the quantity should have been used for the actual good output. Simply means I have an actual and I have a standard. The standard is what it should have been. That's my normal price, my normal quantity. Then I have my actual, what I actually use times my actual price. That's why there's a variance. I have my standard, also known as my normal, and I have my actual. And when I compare the two, I get a variance. So to get a price variance, I take my actual quantity times my actual price minus my actual quantity times my standard price to get my price variance. To get my quantity variance, I take my standard quantity times my standard price, and I take my actual quantity times my standard price to get my quantity variance. And these variances, again, are used to make adjustments later on. How do you find the actual cost? You take the actual quantity times the actual price. Minus the actual quantity times the standard price gets you your price variance. Actual quantity times the standard price minus the standard quantity times the standard price gets you your quantity variance. And here's a nice shorter version of that equation to get each variance. And that's used for both materials and labor. So in our example, we have direct materials, direct labor, giving me a total standard cost per unit. Now, of course, I could find the variances. Using the example, actual quantity times actual price gives me my actual cost. Standard cost, standard quantity times standard price gives me my standard cost. My actual quantity times standard price. Now I could find my variances. $1,800 unfavorable price variance. Quantity variance, $1,000 unfavorable. So total unfavorable direct materials variance. Price plus quantity gets you your total direct materials variance. It's pretty straightforward to understand the variances, and it's important to understand it because you got to know who's responsible to fix it, and especially if it's unfavorable, you got to know who's responsible to fix that problem, and you got to understand how these variances have an impact on product quality and overall financial impact on the company. The same can be said with labor. You have your actual labor hours times your actual rate, your standard labor hours times your standard rate, and then you have your actual hours times your standard rate to get you your variances. The variances in labor hours results in efficiency. That's why it's important to know the variance in labor. It works in really the same way as materials. The same type of concept applies. Actual hours times actual rate gets you your actual cost. Standard hours times standard rate gets your standard cost. And of course, your actual hours times your standard rate is your variance. Unfavorable variance, 1,700 for the rate, but you have a favorable variance for efficiency, giving you a total cost variance unfavorable of $100. So understanding the labor variance is very, very important from that perspective because it's important to know the skills of your employees, how the skills of your employees impact the overall business with respect to efficiency. Who's responsible for those cost variances in labor? Management, of course, is responsible for those. Human resources plays a big role in that. And it's important to understand that so you can make adjustments. The same process this is a little bit different for factory overhead. For factory overhead, it's based off of the estimated level of activity. Total factory overhead cost divided by total estimated activity in terms of hours, of course. We have our standard and we have our actual, just like before. The primary difference here is the allocation. So let's talk about that. First thing you got to do to figure out your standard overhead rate is find your allocation base. Then you choose your predicted activity level. Then you compute the standard overhead rate. That gives you your budget. And we talked a lot about that when we talked about factory overhead 3 weeks ago, 3 weeks ago. So from a budgeting perspective, we take as a percentage, 70%, 80%, 90% capacity. Total variable costs, total fixed costs, based off of those percentages. To get our predetermined factory overhead rate per hour. At 80% is the middle of the range, as they say, so it's an ideal place to be. For the middle of the range, you take your total, sorry, where am I? Yep, I'm sorry. The total factory overhead divided by the labor hours to get $2 per direct labor hour. To find the cost variances for factory overhead, take your actual factory overhead incurred minus your standard factory overhead applied to get your variance. Actual minus the standard gets you your variance. Actual minus the standard gets you your variance. This case is unfavorable, 650. Why is that? Because the actual was greater than the standard. When the actual is greater than the standard, it's unfavorable. When the actual is less than the standard, it's favorable. Okay. Volume variance works the same way. Actual in comparison to the standard. Oh, sorry. And of course, we could do the same thing with sales. Sales, we can compare budgeted to actual, and we could get a sales variance. Actual sales times the actual price, budgeted sales times budgeted price, actual sales times budgeted price, giving us our variance. And it works the same exact way as the other variances have. Same formula. Just instead of it being materials or labor, it's sales. It works the same exact way. And of course, efficiency variances are based off of employee hours, but there's also standard accounting cost system variances, which I'm not going to dive too deep in, but this goes back to overhead. But again, it's the same exact concept. We take our actual minus our applied to get our variance. Actual overhead rate times the actual variance. Actual overhead rate times the standard variance. As we can see, it's the same exact process. And those variances, again, very important to understand because as managers, we can make adjustments based off of those variances. Same exact concept. It's like seeing the same exact thing over and over and over again. The reason for that is because it really is the same exact process. Actual times actual, standard times standard, actual times standard to get the variance, right? Another example. Okay, almost done. This is what it looks like graphically. Graphically, we have fixed overhead, which, as you know, fixed don't change with time, but the variable overhead does, based off of the actuals. Okay. This is a recap of what we went through. And of course, there's always some journal entries. for variances, right? So we allocate our variances to the materials or work in process, wherever the variances belong. So when there is a variance, we would either debit or credit based off of where it's going. But don't worry too much about that. Good to know, but not necessary. And then here's another variance allocation of overhead. And of course, what it looks like on the income statement. And that, my friends, is the conclusion of chapter 23. Flexible budget, standard costs, variances. Any questions? Any questions at all? Comments, concerns?
Yeah, I'm just gonna get kind of like confused with the whole make the variance thing because there's so many paths you have to take to get there.
There are, yeah.
Yeah.
I totally agree with that comment. And one thing I think that is really the most important thing to understand about the variances is really this general formula. Let's see where that slide went. Here it is. So this cost variance computation, and really it all drives down to this formula, because this formula is the same formula applied for materials and labor. Okay, um, and to some degree factory overhead. But first you find your actual cost, actual quantity times actual price. Then you find your standard. Remember, the standard is kind of like your budget. Standard quantity times your standard price. Once you've found your actual cost and your standard cost, then we could find the variance by taking the actual quantity used, times the standard price that you should have paid. And then once you've done that, you would take your actual cost minus variance. You take variance minus standard. And that ultimately gets you your variance in price and variance in quantity. And once you apply that to materials, labor, to some degree factory overhead, you'll have it down packed. It's just a matter of kind of remembering the steps, as you said. I think that's probably the most complex part.
Yeah.
Yeah, great point. Great point. Any other comments, questions, concerns? You're all okay. All right, great. So just to recap, we just finished chapter 23. For this week, you have 2 assignments. First one is chapter 22 homework. Second one is chapter 23 quiz. Both of those are due Sunday night. They can be taken up to 2 times to earn the highest grade possible. Once you're done with those 2 things, when we roll into next week, we'll have 1 chapter, 24. And then week 7, which will be our last week of lecture and last week of class, essentially, we'll cover chapters 25 and 26. And then after that will be the final exam. Wow, look at that. Amazing.
All right. Thank you, Professor.
You're very welcome, Tylexis. It's always a pleasure. And so with that, I hope you all enjoy the rest of your day. Please remember to stay safe, wash your hands, do the right things, and I will see you all again next time. Thank you so much for your time today. Appreciate all of you.
Enjoy your